You are live. Let's see. All right, we got some people spilling in. Awesome. All right, Bill, it looks like you raised your hand to speak, but then you'd put your hand back down. All right, I love it. We're not going to have other people speaking. That could turn into that can go a lot of different ways. It might turn into a full-fledged rally, or it might turn into a name-calling contest. Good morning. Sun City, Arizona. I love to see it. I love to see it. That's the birthplace of Del Webb out there. People think that Del Webb down in Hilton Head is a big one, or Bluffton's a big one. The one out in Arizona, it's got its own zip code. George and Tara, good to see you. All right. Guys, we're just going to give it 2 seconds. Let some people pour in. We're expecting a pretty big crowd today, and I'll get into my presentation. Let's see where we're at. North Myrtle Beach. Hey, Patricia, how are you? Yeah, we've got a bunch of other people pouring in here, so hope everyone's doing good, ready for fall, not getting sick like me, but having 4 kids in your house that are 5 years old and under and at preschool and kindergarten, that kind of comes with the territory. I'm sure you guys have gone through that before. All right, let me get my, all right, people are starting to come in. Good morning, Brian. All right, we're going to distribute this. So if what happens sometimes, guys, is someone's internet connection acts wonky, so your audio cuts out or something, I can assure you all of our computers are hardwired, so our internet is going to be tried and true, and then we distribute the presentation afterwards. So if you got to go, if your phone rings, you can watch that presentation at your convenience at a later point. So good morning, everyone. That's our very own Brittany. All right, start presentation. All right, let's get to it. So why does it start from the end? It did this last time too, Brittany. Slides. Oh, this is very frustrating. It did this last time too, Brittany. Sorry, everyone. This is going to be like watching going to a parade and walking in the opposite direction of it. So you're going to see all of the presentation before it's all done. This is very annoying because this is kind of a long presentation. You're going to see sometimes I'll do a presentation and I don't want to give it away. All right, cool. So I turned around and I changed the title of the presentation to an anatomy of a recession. We're also going to do some year-end tax savings tips. And then, of course, what most people who work with us want to know is, what are you doing? Is my money okay? I'm reading the tea leaves. I'm wetting my finger. I'm sticking it in the air, and I kind of see a lot of ugly economic headwinds. What have y'all done for me to give me a little sleep well at night, warm and fuzzy in my belly? So we'll cover what we're doing as a firm. Most important, here's our compliance slide to keep me in the good graces of all the regulators out there. Regulatory, my industry has gotten worse than ever, or maybe better than ever, depending on which side of the coin you're on. Like I saw fines for financial people are up like 3x, and the amount of paperwork we now need to get signed is gone through the roof. So read every word of that, because that's very, very important with our current administration. All right, so this presentation is going to be a little bit heavier. Sometimes we do a presentation and it's chock full of pictures of my kids. Or I did one where we talked about what would grandma do. Claire's grandma just turned 100 years old. And a little bit more lighthearted and tongue-in-cheek. This one is going to be like Economics 301. Like there are some pretty heavy financial concepts that we're going to discuss. And what they are leading indicators that are pointing to the fact that we are going to fall into a recession if we're not already in one. And there's a lot of people out there going, Adam, you've been saying we're going to fall into a recession all year, yet the stock market's doing phenomenally. Our unemployment rate has never been lower. And I'm not saying that we're going to fall into a recession purely because I'm not confident in the man in the Oval Office. This isn't like a political stance. This is a fact-based thing. So here are 12 leading indicators that most all economists utilize to determine if we're in a recession, okay? And it reads just like a traffic light. Green means go, all is right in the world. Yellow means slow down, we're about to come to a stop. Red means stop. And you can see there's 12 different indicators: housing permits, job sentiment, jobless claims, retail sales, wage growth, commodities, ISM new orders, profit margins, truck shipments, credit spreads, money supply, and the yield curve. Prototypically, if four of these leading indicators are red, we are in a recession or we're falling into a recession. So you can see as of September of last year, 6 indicators went off as red. Today, end of August, every single indicator is negative. 10 of are red, and 2 of which are yellow, one of which is job claims, and the other one is truck shipments. So every single leading indicator is telling us that we are going to fall into a recession if we are not already in one. I'm going to unpack some of these leading indicators. And like I said earlier, this is going to be a really heavy presentation. I am not going to butter you up with a bunch of cute pictures of my kids, because we are talking about tremendously important economic data. And I don't want to just put a bunch of pictures of my cute kids on the presentation to keep your eye. And I would not put a picture of a puppy with my cute kids during this presentation either. I have more respect for my audience here today. All right. Hope you all see what I did there. Here's the capital markets year to date. S&P 500, I pulled this number a couple days ago. The market popped up a little bit yesterday. Looks like it's due to have a good day today. But the S&P 500 is up about 11-12%, depending on which minute you look at it. That's actually come down a little bit over the course of the last 2 weeks. We were up 15-16%. We've had a little bit of a sell-off the last 2 weeks. The NASDAQ is up 35%. As you know, the NASDAQ's mainly compiled up of technology companies. The bond aggregate, this is illustrated with Vanguard's ticker BND. It's a total bond market index, is down 1%. And I'm going to dissect what I think to be a really interesting phenomenon happening in 2023. Vanguard Value Index, as illustrated by ticker VTV. These are dividend stocks. These are big, boring companies that create lots of cash and spit out some of that cash to their shareholders by way of a dividend. Flat or down, depending on which day you look at it. So you see the S&P 500 up in the teens. You see the NASDAQ up 35%. Big, boring, stable, steady Eddie dividend stocks are stuck in the muck or down a little bit year to date in 2023. It's truly a tale of two cities. The green chart here is ticker VUG, which is compiled of what market pundits are calling the Magnificent Seven. So the Magnificent Seven, Apple, Microsoft, Amazon, NVIDIA, Google, Tesla, and Facebook, or Meta as it's called now. When you look at their market caps, because the S&P 500 is a market capped weighted index, meaning larger companies encompass more of the weighting of the overall index. Like Apple represents 7% of the S&P 500. Those Magnificent Seven names encompass 25% of the S&P 500. And you can see those Magnificent Seven names are up over 30%. Comparatively to Vanguard Value Stocks, VTV, the names within that index, Berkshire Hathaway, ExxonMobil, United Health Group, JP Morgan, Johnson & Johnson, Procter & Gamble, Chevron, which isn't to say those businesses are not wonderful businesses that create tons of cash and have been great for investors for decades upon decades. Year to date, they are just getting walloped by those Magnificent Seven stocks. So it's truly a tale of two cities. The high octane growth names are leading all of the growth and, in my opinion, over skewing the overall performance of the S&P 500. If you're a dividend investor year to date, you're sitting there going, why don't I have all my money in the Magnificent Seven names? Because those are the ones that are really burning up the ticker tape. And why are they burning up the ticket tape? Because each of those seven names have an element of AI. Now, we track Google ratings around here, and this is a chart showing some of the Google searches that have spiked over the course of the last 10 years or so. So you remember back in 2018, Bitcoin jumped through the roof, and then it fell off like a cliff. Then in 2022, it was all about the metaverse. That was right around the time Mark Zuckerberg changed Facebook's name to Metaverse and doubled down on the metaverse. So, and of course, metaverse fell right off the cliff. And now most recently, we see artificial intelligence, AI. And then there's a spike somewhere in the middle there. That's a Taylor Swift album that had recently dropped. So artificial intelligence is all the rage right now. And if you were to ask anyone who believes we're not going to fall into a recession and the Federal Reserve is going to steer us into a soft landing, every single person who believes in that worldview will say artificial intelligence is going to lend itself to exponential productivity out of the labor force, and that is going to keep us out of a recession. To be continued, we're already tinkering with artificial intelligence, my little rinky-dink business. It's helpful, it's useful, but it still yet needs a human being to drive it properly. So I don't see it as this disruptive technology that is going to lend itself to each and every one of our employees being 2, 3, 4, 5 times more productive than they already are. I can see it going the same way as the disruptive technology of Bitcoin and the metaverse, falling off of a cliff, yet they're still in the background. Mark Zuckerberg just did a little unpacking of the metaverse, and it looks just insane how much money he's poured into that and how much technology is making that more and more of a reality. So anything that has AI associated with it has shot through the roof year to date. And each of those Magnificent Seven stocks all have that similarity to them. If you scan out, though, however, right, because everyone, we just looked at the market year to date. That's only 9 months. If you scan out and you look at the markets over the course of the last 2 years, the red line is growth stocks. So you can see down 10% over the course of the last 2 years. The blue line would be those very same dividend stocks that are getting trounced year to date. So dividend stocks have continued to outperform growth stocks over the course of the last 2 years. And both of these charts are indicative of what I've riffed on before in previous webinars, that I believe we could be in what's called a cyclical bear market, a prolonged period of time where the market pops and drops, and you look back in arrears and go, boy, we haven't really, we're kind of stuck in the muck. We haven't moved all that far. And that's totally what we're seeing happen with growth stocks right now. Even though they're having a tremendous good year, they still yet haven't gotten to their high water mark that they reached a couple years ago. Are we there yet? So have we reached the bottom of a recession? This chart just simply says that the average recession market bottom is about just shy of 30%. You can see in 2022, the drawdown that we experienced was, I think it was 23 or 24%, not quite to that 29% level. So we have not hit a bottom comparatively to what we've seen in previous years' recessions. Something to chew on. And then finally, to the individuals, I got some good hate mail on a radio show I did last week where I was, unpacking some of these very same concepts. And this individual said, "No way in heck are we going to fall into a recession. Have you seen the jobless numbers?" And Zillow just announced real estate prices went up another 4%. Oddly enough, what you're bearing witness to, these green shoots, these encouraging statistics, are actually very comparable to how we've fallen into previous recessions. How does someone go broke? Slowly, then suddenly. How do we fall into recessions? Slowly, then suddenly, because it's usually liquidity based. And you're going to see on some of these future slides, it points to that very same concept. So typically GDP growth is coming up aces as we go into a recession, and then all of a sudden, boom, liquidity dries up, businesses stop borrowing money. Once businesses stop borrowing money, they start laying people off. Once people start laying off, we see delinquencies go up. And then next thing you know, you're in this recessionary cycle where people have to start selling their houses, real estate prices. It all kind of looks like a contagion or a set of dominoes falling one by one. So that's typically how a recession comes to light. It's not this slow kind of Eeyore crawl towards despair. It usually happens relatively quickly. And going into that cycle, the numbers could be encouraging. I just made mention to something like this. This is very troubling to me. So this is small and large companies' loan demand. Okay. So what this is showing you is businesses are not borrowing money. In fact, they're not borrowing money to the same level that they didn't borrow money during the dot-com bubble and at the heart of the financial crisis. Loan demand for business has fallen off of a cliff. This hits very close to home. My business, we are stockpiling cash. We're not borrowing money because I think we're entering a wintry season. So I don't want to borrow money. Not to mention, who wants to borrow money? If I were to buy a commercial building right now, I'm borrowing money at 7, 8, 9%. Business lines of credit are in the teens. Credit cards, I'm about to show you, are at 22%. So businesses have stopped borrowing money. This is a big time leading indicator because businesses, when they are feeling optimistic, they borrow money and they deploy that money at marketing endeavors, or they deploy that money at R&D, or they build little enclave branch offices throughout the country and try to grow their business with boots on the ground. That's not happening. In fact, businesses have turned off the lending spigots to the same degree we saw in really, really ugly market conditions, the dot-com bubble and during the financial crisis. All the while, businesses have stopped borrowing money. Main Street consumers are back to their borrowing ways. The chart on the left shows the average credit card rate in this country. It's 22%. God, if you're listening to this right now, I hope you're not borrowing money at 22%. If you've got kids or grandkids borrowing money at 22%, they are a hamster on a hamster wheel going nowhere fast. This is higher than we've seen since, I don't remember when credit card rates, probably since the 80s, credit card rates are that high. Look at the chart on the right. So I couldn't believe my eyes. This is revolving consumer credit. Okay. So if you remember, during COVID, I was seeing headlines where consumers were paying off debt and stockpiling cash. And I was shocked. I go, oh my gosh, it took a global pandemic for Americans to start saving money again. It took a global pandemic for people to recognize that having an emergency fund and not living off credit card debt is a tried and true way to build wealth. Well, that was very short-lived. We saved money for about 2 years, and within the last year, credit card debt, revolving consumer credit has shot right back up, where we are right back to being on trend, where we're darn near $1.3 trillion of consumer credit is lingering out there. So at the same time, businesses have stopped borrowing money to grow and expand and give out pay raises and do marketing endeavors to grow their revenue. Consumers, Main Street investors, and Main Street people who don't own businesses are borrowing money at clips we've never seen before. Delinquency rates, still yet low historically. So these are people welching on their debt. So you can see these delinquency rates are nothing like what we saw during the financial crisis, and still yet historically low compared to what we saw in 2015, 2018. But if you look at this, the tail end of it down here and towards the right, everything is trending up. Now, everything is trending up except one thing: student loan debt. Why is student loan debt not trending up as far as delinquencies are concerned? Because you don't have to pay your student loans back. As part of the Inflation Reduction Act and some of the COVID bailout packages, we've suspended student loan debt repayment for the last 3 years. People haven't had to pay their student loans back for 3 years. That comes to an end. I don't know if it's at the end of the year or a month or two from now, but in the next few months, student loan debt will have to be paid back. And watch how quickly that trend line spikes up into the right as we see more delinquencies on people welching on their student loan debts. But certainly cars are starting to shoot up, credit cards. How could they not? At 22% interest rates, you're going to see more and more delinquencies come across the news wire. I'm sure of that. And then, of course, what everyone points to, most people regard as the most important economic statistic to follow, is jobless claims, right? Because America is a consumer-driven economy. And funny thing about consumers, when they have jobs, they spend money. And when they don't have jobs, they don't have money. And 2022, we had a 53-year low on jobless claims. But that number's trending up. You can see that jobless claims are starting to go up and to the right. And I have I could probably talk for an hour about why I think the way in which we track the jobless claims number is kind of artificially manipulated. We use the same exact calculation that we used back during the Great Depression. When someone lost a job, they immediately lined up in a unemployment line, and then right after the unemployment line, they went to the food line. This is not taking into consideration the entire workforce participation. We have a lot of people in the gig economy. We have a lot of people that are underemployed, meaning they have, they're technically employed, but they're employed doing something that's below their pay grade. We have a lot of people that have just given up on work. They're living in their parents' basement. We have a lot of people that are gearing up for retirement and, are 62 years old and have lost their job and are not being factored in the unemployment rate because they're of Social Security claiming age. So there's those things. And then I am actually just of the mindset that the real unemployment rate might be negative, because there's more job opportunity out there than there are employable human beings willing to take the job. That's what we see as a firm. We just filled 2 job positions. We're actively always looking for more people, but we want the best and the brightest out there. And finding these people is like sorting through a haystack looking for a needle. There are so many people who don't fit our culture. They're entitled. They just because you have a college degree doesn't mean you're equipped to work at this place. And that's synonymous with lots of other employers out there too. So, but we are starting to see jobless claims go up and to the right. And I'd imagine that trend is going to continue to happen. Now, I know what a lot of the God-fearing, flag-waving talk radio crowd thinks. They go, $33 trillion in debt, Adam. When are we going to fall off the fiscal cliff? I heard our debt service payments are at the same level as our military payments, right? Well, this is from the Congressional Budget Office, which I kind of trust as far as I can throw it, unfortunately, even though it's still yet widely regarded as our, voice of reason in the room as it relates to economic data. The problem is with a lot of their models, they assume GDP growth only goes up and to the right. They assume that we're going to have this consistent, steady GDP growth. But what this chart is pointing to is, even though we're riddled with debt, even though our debt burden, $33 trillion, as a percentage of our GDP, is as high as it was at the end of World War II, because interest rates have been so low, the debt servicing cost is not even as high as it was back in the 1980s or 1990s. Now, what they anticipate, though, in the next few years, we will go back to where we were in the 1990s without major changes. So maybe just to add a little kind of water to the fire, I know this is something that's heavy on a lot of people's hearts and minds. The U.S. debt right now is not insurmountable. Our debt servicing payments still yet represent a very small percentage of our GDP. So rest easy. Let me take that back. Maybe don't rest easy, but this is not the reason you're going to be living in a bunker eating bugs. Again, tip my hat to my talk radio listeners out there. The debt service payments are not insurmountable. We've been here before. If we continue to pretend this isn't a problem, though, you can see how by 2030, we're now at modern day all-time highs, which is 2030 is not that far away. It's pretty darn troubling to see that. So what do we do? What are you doing? This is my 22-month-old, and she wakes me up every morning anywhere from 4:30 to 6:30, and that dictates how I feel that day. But she looks like this. Okay, Dad, I'm up. What are you gonna do for me? You gonna get me some milk, Cheerios? How does the day look? Guys, I have made my career on this rudimentary allocation pyramid, as we call it. But so many of you who've been working with us for years and years and years, you come in for your review and you go, you're not going to draw the triangle again, are you? And I go, you bet your butt I am. I have never been more convicted that compartmentalizing a retiree's portfolio into the different tiers and tranches that you see in this allocation pyramid is a winning recipe to have confidence in retirement. It's a way in which you can invest your money where you're not betting you're going to be right? We're not in the business of, all right, this year we're going to pick tech stocks. Okay, next year we're going to put dividend stocks. Okay, let's get out of the market entirely and sit in treasuries. I don't want to bet I'm going to be right every year. I just want to bet I'm not going to be wrong, especially with the individuals that we get to help. People in or nearing retirement. You can't afford to go back to work and make it all back again if we make a bad bet that doesn't materialize. And what I'm finding, especially this year and last year when the market had a more challenging year, the individuals who are allocated as illustrated on this very simple slide spend money more confidently. They have less anxiety about the market. Their performance generally winds up better. Anytime we part ways with a client, and I wish I could say that never happens, but as we've gotten bigger, there's thousands of people, every now and again, someone, decides to go in a different direction, and that's fine. Anytime someone decides to disengage with us, almost 100% of the time, we look at their portfolio, and their portfolio was designed in a cafeteria style way. Now, what does that mean? It means they go, yeah, Adam, I want the middle stuff, but I don't want any of the bottom stuff. Yeah, I want my money in the growth names, but I don't want anything in stuff that's principal protected. Yeah, give me the dividend stocks, but I want nothing to do with the growth stocks. Anytime people try to let's face it, they steamroll us and they go, yeah, good plan, but I don't want to do this. I just want to do this part and this part. It's not how it works. And I'm almost becoming a little bit jaded at this stage of my career where I'm like, guys, this is how I'm going to allocate my own personal resources when I go to retire. This I've come to see is a balanced way to allocate your funds. And if you're working with us and you're going through your reviews, the advisor you're sitting with is probably going to draw a triangle. And I know you're going to roll your eyes and go, don't tell me you're drawing a triangle again. That's by design. That's purposeful. We want to show you the nuance within your portfolio. And I'm going to go into each one of these tiers in the coming slides, but I truly believe in my heart of hearts now more than ever. And if what I'm saying is resonating with you, if you're one of the individuals going, yeah, you know, I didn't want to do that piece, so I did this piece and this piece. My guess is you're probably like, hey, why isn't my performance where it should be? And shame on us to a certain degree with some of you, because we should have dug our heels in. We should have said, no. We need to have this compartmentalized portfolio. This is what works. And I've never been more convicted when I look at our client accounts right now, and we come in for reviews with individuals and we see the people that are joyfully spending money and checking items off their bucket list and not worried about the $33 trillion in debt or if we not fall into a recession. But the individuals who are typically have deviated from our prototypical allocation. Now, every single one of you who are in this, watching this right now, have a portfolio that's been specifically designed for you. It's unique to you. We don't put together boilerplate plans. Even though it says 60-40, most all of you have a little nuance to your portfolio. Some of you might have top-heavy pyramids. Some of you might have bottom-heavy pyramids. But using all of those different investment worlds, in my opinion, is a winning recipe. So what's at the base of the pyramid? Keep it simple, keep it safe. Look at CD rates. 3-month CDs, 5.5%. 9-month CDs, darn near 5.6%. Now, as we go longer in duration, 3-year CDs, 5%. Right below CDs, we have U.S. Treasuries. 6-month Treasuries, 5.55%. We can buy these right in your Charles Schwab accounts. Now, here's what I've been spending a lot of time kind of telling people who work with us, and I was going to say not pressuring, but trying to convince people who work with us that naturally, and I've said this on different webinars, naturally, if I say, hey, do you want the 6-month CD paying 5.5%, or do you want the 3-year fixed annuity paying 5.6%? 9 out of 10 of you are going to go, give me the 6-monther. People will have a bias towards liquidity, as they should, because we all want the same thing: growth, liquidity, security, tax sensitivity, low fee structures. So people are naturally going to be interested in shorter termed fixed instruments. In my opinion, with everything you just saw, the fact that the recession dashboard is signaling signs of red. Corporations aren't borrowing money. Consumers are racking up debt. Jobless claims are going up to the right. Delinquency claims up to the right. What you want to do in that environment is kick the can down the road 3 to 5 years, not 6 months. Because if you buy the 6-month thing or the 9-month thing, when that matures, you might not be greeted with higher interest rates. That's not a guarantee. So really what you should do is build a ladder. So if you have $100,000, you take $30,000 of it and you buy the 6-9 month. You take $30,000 and you buy a 1-year to 2-year. You take $30,000 or $40,000 and you buy the 3 to 5 year. You build a cascading effect of liquidity. That's what I believe is the optimal way to build the base of your pyramid. Use a ladder and layering techniques. Another thing at the base of the pyramid are linked accounts. Now, I pulled this off of a full-fledged illustration. This is purely for illustrative purposes only. I'm happy to send the full illustration to you. But the point is, just like fixed rates are higher than we've seen in darn near 20 years, linked rates are the same. They're benefiting from a higher interest rate environment as well. This shows a linked account with an 11.25 cap. The best 10-year time period, you're making about 8.7. The worst 10-year time period, you're making 6.8. In the last 10 years, you're making about 7%. Other webinars I've done, I shined a light on Vanguard's economic outlook. And Vanguard has came out and said over the course of the next 10 years, they only see U.S. equities growing 4 to 6%. Linked accounts, 6 to 8%. Now, linked accounts, market linked CDs, fixed indexed annuities, you're giving up liquidity there. Generally, it's a longer holding period, but you might get a higher rate of return than what you could achieve with a CD or a treasury or a fixed annuity. So we like linked rates. I think it's something that complements a fixed portfolio at the base of your pyramid. Do we turn our back on the market? Do we just put it all in fixed things? I don't think so. We still love dividend stocks. And I know that's probably, I should say that with shame because dividend stocks have been flat year to date. I have a larger lens that I look at the market. I'm not a day trader. I'm a retirement planner. I need people to stay retired 20, 30, 40, 50 years. We're not trying to jump in and out of the market, and we still love dividends. This chart shows the S&P 500 with dividends and the S&P 500 without dividends. The difference is $3.4 million by collecting your dividends. Granted, this is from the 1960s, so there's been a lot of years of compounding. But the point is, dividends are a retiree's lifeblood. Not to mention, dividend growers and dividend paying stocks typically outperform during rate hikes, after rate hikes, and leading into rate hikes. So we haven't seen that this year, but when you pan out over the last 2 years, dividend stocks have outperformed growth stocks. I think sometimes we have a bit of a recency bias, especially if you watch things like Fox Business or CNBC. You see a man on TV wearing makeup talking about their next trade. They're looking at the capital markets under too short a lens. Dividend stocks typically perform well in a raising interest rate environment. We haven't seen it in 2023, but we've certainly seen it in 2022. I still am convicted that dividends are a good thing for retirees. Even if I'm wrong, if you go, Adam, you're reading the tea leaves incorrectly. I know the clients that we work with who have dividend-focused portfolios will continue to collect a consistent dividend income payment like clockwork. Our dividend driver model right now is yielding over 5.5% of dividends, just flowing like clockwork. You would need every single company within that portfolio, which there are hundreds, to suspend their dividend or lower their dividend, which is highly, highly unlikely, especially being as though that most of the names in that dividend portfolio are dividend aristocrats, meaning they've raised their dividend for 25 years in a row. So we continue to like dividends. This is a cool chart. So the blue line, and what this speaks to is time in the market is more important than timing the market. So I know a lot of you are going, hey, 5.5% on a treasury, that's juicy. I tend to agree with you with fixed rates being as fortuitous as they are right now. It makes sense to me to have a bottom heavy pyramid. However, what this chart's showing you, just to add some nuance to play devil's advocate before you put it all in fixed instruments, the green line is someone putting $1,000 in the stock market. Every single year, they put $1,000 in the market. This is dating back to 1950. And this has to be the worst investor on the face of the earth because they put $1,000 in the market at the absolute worst time, the high watermark. And I know some of you have probably done that in the past and like, oh gosh, I'm the worst investor. Well, look at this guy. He's the worst investor ever. He buys in to the tune of $1,000 at the high watermark each and every year. He has $2.2 million. The person who bought treasuries has $400,000, which is to simply say, don't turn your back on the market. It has been a wonderful mechanism for wealth accumulation and growth. And I know sometimes we kick ourselves because we buy high and, we say, boy, why did I buy at that particular time? It's not about timing the market. It's time in the market. And I'm going to show you some slides which speak to that very same phenomenon. And there's so much to panic about. And here's why Main Street investors typically have a tendency to buy high and sell low. This is just over the course of the last 5 years. I mean, I'm not going to go into every single one of them, but you've got COVID, you've got the regional bank crisis, you have the inverted yield curve, U.S. election concerns, so many things, especially with social media. And, if it bleeds, it leads in the news media. There's so many things to panic about. These panic attacks that retail investors have been subjected to, you're not going to believe this. The average investor in the United States over the last 20 years has only averaged 3.1% rate of return annualized on their money. Inflation has ran 2.5. Real estate prices have been 3.7. And you can see U.S. equities 9.8, REITs 8.4, international equities 7%. So because of those panicky moments where we call and we go, hey, let's deviate from the plan. Let's sell all of our growth stocks and put them all in fixed instruments or treasuries. Because of those shifts, the average investor in this country has only averaged about 3% per year. Food for thought when you're contemplating making a complete sector rotation or a complete rotation of your portfolio. We'll get a call periodically. Adam, I'm thinking about getting out and putting it all in gold. Or Adam, I'm thinking about pulling it all out of the stock market and putting it in cash. That never bodes well. And we try our best to dissuade you from that. But sometimes at the end of the day, it's your money. We have to honor your wishes. All we can do is show you some statistics that typically average investors are not particularly good at timing the market. And here's just another one. They say Las Vegas wasn't built on the winners. This is every single annualized rate of return for the S&P 500 since 1926. 73% of the time, the market is going to go up. So even though I just laid out the entire case for us falling into a recession, recessions are typically very short-lived. Not every recession is like 2008, where they get coined like the financial crisis. The financial crisis was a true cataclysmic recession. This next recession is not going to be exactly like that one. It could be different. So generally, over long periods of time, if you're patient, if you have a plan, if you have nuance within your plan, where you have a portion of your money in things that are going to be a little bit more predictable, you have a portion of your money in things that are going to generate ongoing dividends and interest that you can spend foolhardily. There is no reason why retirees shouldn't have a portion of their money in things that are going to be allocated for long-term growth. Put some hedges in there so you smooth out the ride. But the market, in my opinion, regardless of what the United States is up against right now, will continue to be a source of growth for the rest of my life and for the rest of my kids' life. I know that's a bold statement, but I believe it in my heart of hearts. Tax tips. So I'm going to burn through these because I know I want to keep us on schedule. But 7 quick year-end tax tips. We actually have a checklist internally in our office. And all you should do is call our office up and just go, do it for me. Or you can do it on your own if you're a do-it-yourselfer. Here's the 7 things I'd fix my eye on. One is the holy grail of tax savings are what we call above-the-line deductions. So this is making sure you max out your retirement contributions. If you have a 401k, we're coming to the end of the year, so reach out to your human resources department. If you got cash sitting on the sidelines, max out that 401k contribution. If you started a little business, make sure you have the right chassis So that might not be a traditional IRA. It might be a simple IRA. It might be a SEP IRA. Those retirement plan chassis need to be set up before the end of the year. If you have a high deductible health insurance plan, make sure you make an HSA contribution. That is an above the line deduction. If you or your spouse doesn't work, you're still yet entitled to make a spousal IRA contribution. In many cases, those above the line deductions represent a dollar for dollar reduction in your income. So if you're in the 22% tax bracket and you put $10,000 into above the line deductions, you just saved yourself $2,200 in taxes by shifting that money many times from your bank to an IRA, from your bank into an HSA, and you're going to turn around and use the money in the HSA for ongoing medical costs anyways. So be very mindful of the above the line deductions that you have at your disposal. We're doing a lot of capital gain analysis, especially with how this market has performed. You want to harvest your capital gains and your capital losses, balance them together. So say you own some Apple stock that's up $20,000. But on the other side of the coin, you have some cryptocurrency that's down $20,000. Well, it might be a good idea to sell the Apple, sell the cryptocurrency. Now there's wash rules, so you don't go right back into Apple. But you might buy a growth ETF that's washed your Apple stock of its capital gain that allows you to reset. And I don't believe there are wash rules when it comes to cryptocurrency. So you can actually turn around and rebuy the cryptocurrency. But be mindful of the wash rules, balance your capital gains against your capital losses, and make sure you capture a $3,000 loss. And let me defend people who have losses right now. Heard a really great quote, and I said, that is spot on. Part of diversification, good diversification anyways, is you should always be able to point to something in your portfolio that you give the stink eye. Being diversified means you're always going to apologize about something in a portfolio. I see that with us, our dividend driver model, for instance, right now. Well, one, it just isn't burning the ticker tape up, but it's still yet paying great dividends. But there's like an international dividend stock in there, and it's just like not doing well. It's still, in our opinion, the best way to gain exposure to international dividend stocks. It's got a low expense ratio. We monitor it. We compare it to other alternatives. We think it's the best thing. But it's red for so many of you. So sometimes people call up and go, Adam, why do I have this stinker right here? And my take is because guess what's going to happen to that stinker next year? And the one that you're so proud of this year, there's going to be a complete reversion. So now is a good time to balance your gains versus your losses, capture losses, use that $3,000 tax loss on your tax return. RMDs, Christine and her team right now are actively calculating. So if you're over the age of 72, rest easy. Our office handles your RMD for you. The rules have changed dramatically. And I will not even go into them on this webinar because it would take me probably 30 minutes to unpack them all. But some of you, your RMD has been bumped up to age 73 or age 74. There's been some new guidance issued on the 10-year rule. Remember, you used to be able to stretch an IRA out for 120 years. Now you're required to distribute it in 10 years. The IRS has lowered the penalty on RMDs. It used to be like 50%. I think it's down to 25 or maybe even 10. Too many things for me to keep track of. I've got a little sheet that keeps me in the know when I'm sitting with individuals. But they've lowered the penalty. So some people will be like, oh, good. Now the penalty's lower. Here's what that tells me. They've lowered the penalty so they can issue more penalties. They'll feel a little bit better about issuing you a 25% penalty or a 10% penalty rather than levying a 50% penalty on you, which is tremendously predatory in my opinion. So know the rules surrounding RMDs. If you are of RMD age and you are giving money to a church or a charity, please lean into our office and make sure those charitable givings are being processed as qualified charitable distributions, so you realize some economic benefit from those charitable funds going to the causes that you want to support. If you're under RMD age, meaning you're under 72 years old, and say you're working and good chance you're going to stop working in the next few years, you might consider bundling your charitable giving by using what's called a donor advised fund. This is how my wife and I do our charitable giving. You contribute to a fund in a more, aggressive way. That way your standardized deduction, you're able to use an itemized deduction rather than a standard deduction. 80% of society now uses a standard deduction, especially since Trump's tax reform. It's got it up to darn near $28,000. So some of you are giving money to churches and charities and not getting any economic benefit from it. Now, you're getting a moral benefit. You're getting a good feeling that you're being a charitable person. But I just assume you actually get a deduction on your tax return, all the while you have that warm and fuzzy in your belly that you're supporting causes that are near and dear to you. Roth rollout conversions. Colin in my office is doing a lot of heavy lifting tax planning right now. Our tax code is going to change at the end of 2025. Couple that with the $33 trillion in debt. Couple that with the fact that we just learned the government is very good at manufacturing a crisis and getting us all to walk in lockstep like sheep. Hate to be a tin hat wearer, but it's kind of just what we just witnessed. It's not outside the scope of reality that we see our tax brackets jump up in a major way. This is what we saw in years past when our debt to GDP ratio was comparable to where it's at right now. Look at the tax tables from the 1960s and the 1950s. The highest bracket was as high as 80%. The lowest bracket was 22%. You look at our brackets now, lowest bracket 12, then it jumps up to 22. It's not outside the realm of reality that we might see those brackets jump 20, 30% higher. So converting money from traditional IRAs to Roth IRAs is a worthwhile mathematical exercise that you should go through with someone in our office. Raise your hand, reply to the email, say, hey, I want to go through the tax planning checklist with you. Finally, mind your business. That just means if you own a business or you're hustling on the side, the floodgates of tax saving strategies swing open for you. One of our clients did something unique. I still just keep harping on it because I think it's so nifty. They go and rent their house as a short-term rental for 90 days every year, and then they go live in Europe. And by doing that, they lose some benefits. For instance, they needed to get some additional insurance on their house. They have a more egregious tax profile because in South Carolina, if your home's a rental, you have to pay nearly double the property tax. There are some drawbacks to that. They lose their ability to do a 1031 exchange in the future. So there are some drawbacks to that. But what they gained from it is they can now write off their mortgage interest. They can write off those tax payments that they have to pay. Maintenance and upkeep is now a deductible experience. So we can get as creative as you would like. We need you to lean into us, though. I like to think, if you've been with us long enough, I've long held the belief I'd love to do tax preparation under our roof. But what I don't want to do is make a promise to you all that I cannot deliver on. So if I hire a tax preparer and they decide to have a midlife crisis and go, I don't want to do this anymore, I will be darned with 4 kids if I'm sitting here till midnight preparing your taxes for you. Not to mention, I don't even have the licensing to do that. So we're going to be just very calculated in how we unpack something like that. But what we do want to do for you, we're not going to sign your return, but we're going to do all of the heavy lifting necessary to make sure you're taking advantage of the tax law the way it's written, so you're not paying a red cent more in taxes than you're legally obliged to. Let us go walk you through that checklist and walk you through that experience. And then finally, it's always a good idea to review your beneficiaries, especially being as though the 10-year rule, the IRS has given us more guidance on that. When you meet your maker, your heirs will have to take ongoing distributions and your IRA will need to be exhausted in 10 years. So what we're advising a lot of people to do is take some of those contingent beneficiaries. Most people, husband, wife is your primary, contingent beneficiaries, your kids. What if you took your grandbabies and put them on the contingent line? Now you're stretching your IRA out across more entities, and each one of those entities needs to take it out over 10 years. So review your beneficiaries, determine if they're optimally allocated. And again, another thing that we can do with you. Finally, Oktoberfest. This is by far my favorite client and referral event we do every single year. The people who printed our invitations fell asleep at the wheel. So most of you got your invitation, I think yesterday they were hitting mailboxes. Heck, some of you might not have gotten your invitation quite yet. We did send an email a week or two ago. We sent another email this week. But if you're still watching this, Oktoberfest in Charleston is next Wednesday, October 4th, 6 p.m. to 9 p.m. If you haven't been to this thing before, I don't really do a big spiel. With exception to last year, I kind of went scorched earth on woke companies and wound up losing 5 clients. So this year, I am going to be, thank you everyone for being here. It is a very, it's all about having fun. We have the German Oompa band. We've got German food. Everyone on our team is dressed in Drendels and Lederhosen. So if you want to wear your Drendel or your Lederhosen, you will be in good company. And this event is all about just spoiling you for putting a little faith and trust in our company. Come on out, have a bratwurst and a beer. Let us spoil you. Bring a friend. We are capitalist pigs. We've actually scaled back the marketing that we do dramatically because the theme of this year is get better, not bigger. But we are capitalist pigs. We want to grow by replicating people just like you. So please invite a friend. You don't need to sell our services, but just simply say, hey, these are the people we work with. Send them home with a book or something like that. Maybe they'll kick our tires and give us a test drive and see if we're going to be the individuals that can, help them to and through retirement, just like we're helping you. So join us Wednesday the 4th and all of our friends up in Myrtle Beach. You got one extra week. We'll do yours Thursday, October 12th. That's going to be at the same place we did our event last year, right there at Gordon Biersch Brewery in, what is that place called? Market Commons, I think it's called. So can't wait to see so many of you at that event. I'll be wearing my Lederhosen with bells on. In Charleston, I'll be probably chasing 4 kids around. So sometimes I feel guilty. I'm not able to invest more time with each and every one of you, but can't wait to see you guys out at our October 4th, our Oktoberfest events. If you need more details on that, again, email our office. Thank you for placing your trust in my little rinky-dink American dream. Please lean into us. We have systems in place to ensure we reach out to you on a periodic basis. We try our best to do webinars like this to keep our clients abreast of what's going on in the capital markets and what's going on in our head. But sometimes, I hate to say it, there is an element still yet of the squeaky wheel getting the grease. We don't have a standardized process right now to review every single one of your tax returns other than outside our annual reviews and when we get together when major life events happen. We need your help to remind us to review your tax returns. So please lean into our office as much as possible so we could deliver the top-notch experience that you so deserve in working with our little company when you had so many other options to work with. Thank you, guys. I appreciate it. Let's see if there's any chat questions I can answer. Really thought-invoking webinar. Thanks, Andrew. Great presentation. Looking forward to it. We'll be in town. Oh, cool. You will win the prize for being the farthest person away. Arizona. Student repayment starts this month. Thanks, Scott. Scott did a cool webinar with Scott, or a podcast with Scott, where he was talking about P&C insurance, auto insurance, home insurance, something that you guys should go back and listen to because I know so many of your rates are changing. That looks to be all of them. Thank you guys so much. Look forward to seeing you guys. And again, we've recorded this. We'll send it out in due time.